Welcome to the Deep Dive. If you're looking for the quickest, most actionable insight into how Home First Finance Company India Limited, that's Home First, has been performing recently, well, you're definitely in the right place. Today, our mission is really to go beyond just the numbers and their latest results. We're looking at the reviewed financials and the investor press release for Q2 FY26, which ended September 30, 2025. We want to synthesize those financial wins, sure, but also dig into the strategic moves they mentioned and, crucially, unpack what's happening with asset quality.
And, we really have to start with the context management gave us. This performance, it didn't just happen in a bubble. They were pretty clear they're operating in a, quote, subdued macro environment.
Right.
They mentioned things like longer monsoons affecting activity, and this is key, I think, ongoing tariff hikes really putting pressure on certain business sectors where their borrowers work. So, every positive number needs to be seen against that backdrop. They're navigating some real headwinds.
Absolutely. And that really sets up the central tension here, doesn't it?
Yeah.
You see this robust profitability, impressive AUM growth on one side, which looks fantastic. But then you realize that growth is being actively sort of moderated because of very specific asset quality issues popping up in certain areas. It's that classic dilemma for a high-growth company. How fast is too fast?
Yeah.
Okay, so let's unpack this. Let's start with that top-line story then, because it does show real discipline. Their assets under management, AUM, hit 14,178 crore.
Wow.
Yeah, that's big growth, 26.3% up from last year, and even 5.2% just in the last quarter.
That's pretty strong quarter on quarter, too.
Exactly. And management seems pretty confident they actually guided investors to expect them to keep up a 25% plus AUM growth rate for the full financial year.
And that kind of aggressive AUM growth, it fuels the earnings power, right? Profit after tax, PAT, came in at 132 crore. That's a huge jump, up 43% year over year.
43%.
Yeah. And their return on assets, ROA, basically how much profit they squeeze from their assets, was a very healthy 3.8%. These are, really strong metrics for the sector.
Okay, hold on. I want to jump in on the return on equity, the ROE number, because this is where it gets a bit nuanced for the listener, I think. The report says 13.4% ROE. So why is management suddenly pointing everyone to a different, higher number, this pre-money adjusted ROE of 16.7%?
Yeah.
What's the actual story there?
Right, and that's probably the most important clarification they made this quarter. The difference boils down to the recent QIP, the qualified institutional placement.
The big equity raise.
Exactly. When you raise a chunk of capital like that, it temporarily makes your equity base bigger on paper. But that cash hasn't really been put to work yet, right? So your reported ROE naturally looks a bit lower just because the denominator is bigger.
Okay.
By showing that pre-money adjusted figure, they're basically telling you, the listener, look, this is the real earning power of our existing business before that temporary dilution effect from the new capital kicked in.
Got it. So if I'm understanding this right, we should probably focus more on that 16.7% number because it reflects the underlying strength of their lending engine, not just a temporary accounting blip from cash sitting there waiting to be deployed. That seems like a critical distinction.
Precisely. And it wasn't just earnings. They were efficient on the cost side, too. Their cost of borrowing, the COB, if you exclude co-lending, actually dropped by 30 basis points just in the quarter, down to 8.1%.
Getting cheaper.
Yeah, and they expect to push it even lower, aiming for under 8% by March 2026. Managing that liability side so proactively, it really helps support their spread, excluding co-lending, which was 5.3%, actually up 20 basis points quarter on quarter.
Okay, that sounds like a pretty tight, efficient operation. But, fast growth sometimes brings future headaches. Did they tap the brakes anywhere? Let's maybe shift to the growth engine itself. Disbursements.
Well, disbursements were 1,289 crore. Still solid growth, up 9.6% compared to last year. But interestingly, management did mention on the earnings call that this number was actually a little lower than what they'd expected internally.
And there's a strategic nugget we were kind of looking for. Why would a company with 43% PAT growth voluntarily slow down its lending, even slightly?
Because, and they were quite explicit about this, it was a conscious choice. They saw specific, clear warning signs emerging in certain loan groups and, importantly, certain geographies.
Right.
So rather than just chasing that last bit of disbursement growth, they made a deliberate call to put in place some proactive restrictions. They actually increased rejection rates in those specific cohorts.
So prudence over speed.
Exactly. They're prioritizing the quality of the assets they're adding to their books right now over just hitting a slightly higher volume number. It's management basically saying, let's sacrifice a little short-term penetration for better long-term portfolio health.
And that decision must then shape their whole operational strategy, right? Across their, 163 branches and 366 touch points. They can't be expanding everywhere equally if they're being cautious.
Correct. The focus right now is really on deepening their presence where they're already strong states like Gujarat, Maharashtra, Tamil Nadu, Andhra Pradesh, Telangana, and Karnataka.
Okay.
And conversely, they're actually slowing down new expansion in some of the, let's call them emerging markets for Home First, like UP, Uttarakhand, and Rajasthan. It feels like a stabilization play. Consolidate where you're strong, shore up underwriting there, rather than stretching resources into newer, perhaps less predictable areas right now.
That focus on maturity, it seems to extend to their digital side, too. They keep posting really strong numbers there, which must drive some of the efficiency we talked about earlier.
Oh, absolutely. Things like account aggregator penetration that hit 83% of new approvals. That's a massive shift towards digital verification.
83%, wow.
And customers seem to be on board. 96% are registered on the mobile app, and get this, 87% of all service requests are now coming in digitally. Think about the cost savings there, the lower cost to serve.
Huge.
And just touching on ESG quickly, their commitment seems solid. Morningstar Sustainalytics kept them in the low ESG risk category, even improved their score slightly. Plus, they certified another 50 green homes this quarter, bringing that total up to 240.
Okay, so strong efficiency, strategic focus. Now let's pivot to that critical area that seems to be driving some of this caution. Asset quality. We did see, as you hinted, the effects of that tougher macro environment showing up, right? A slight rise in some delinquency numbers.
Yeah, a marginal rise. Gross Stage 3 or GNPA, those are the more serious non-performing assets. It ticked up slightly to 1.9%. That's up 10 basis points from the previous quarter.
Okay.
But I think what really prompted the action, the conscious slowdown, were the earlier warning signs. The 1+ day past due, 1+ DPD reached 5.5%. And maybe more concerning, the 30+ DPD hit 3.7%.
And that 30+ DPD number, people overdue by a month or more, that rose 20 basis points in the quarter. When you see that, it suggests those early signs of trouble aren't just blips, they're sticking around a bit longer.
Exactly. That's the kind of signal that likely made management say, okay, time to pull back slightly on the disbursement lever.
Right. So this raises a key question then. Is this a widespread issue across their whole loan book, all their states? Or is it more isolated? And what's really interesting is how specific management got in their explanation.
Yeah, they were very clear. It's absolutely concentrated risk. And this, I think, is the real deep dive insight for listeners. Management got super granular. They pinpointed two main pockets of stress, and they tied them directly to external economic factors.
Okay, like what?
They explicitly called out problems in the leather industry, concentrated around Chennai, and also in the textile industry, particularly in and around Tirupur and Coimbatore.
Ah, specific industries in specific locations.
Precisely. And they largely attributed that stress to the ongoing tariff uncertainty and the ripple effects that has on businesses in those specific manufacturing and export-heavy regions.
So, importantly, it doesn't sound like a fundamental flaw in their overall lending model necessarily, but more like an external shock hitting areas where they have specific industry concentrations.
That seems to be exactly their read on it. And they didn't shy away from the collection pressure either. They acknowledged the overall bounce rate in October 2025 was 17.4%. They admitted that was, quote, slightly higher than expected. And they know they have, in their words, hard work ahead in the coming quarters to really bring those collection numbers back down into their comfort zone.
But in response to this, they seem to be holding the line on their provisioning, right? Credit costs stayed stable at 40 basis points for the quarter, and they're guiding to keep it around that 40 BPs level for the full year. What does that tell you?
It suggests that even with these localized flare-ups, they feel the overall portfolio risk is still well contained. They believe their current provisioning levels are adequate. Okay.
Their provision coverage ratio, the PCR against GNPA, was sitting at 40.8% as of September. It shows that disciplined risk management is still front and center. They feel they're appropriately provisioned for the risk they're currently seeing, which lets them stay confident about that full-year credit cost guidance.
Right. Okay, and finally, just a quick mention of governance and personnel changes. Anything major there?
Pretty standard stuff, really. The board gave Mr. Shreyans Bhakhat the additional hat of head legal effective October 1st. He keeps his existing roles as company secretary and compliance officer, too.
Okay.
And on the departure side, Miss Vilasini Subramaniam, who was head of strategic alliances and considered senior management, resigned for personal reasons, effective mid-November.
Hmm.
Just the usual kind of updates for a growing company, nothing too dramatic.
Okay, so wrapping this all up, what does this mean for you, the listener, trying to understand Home First?
Well, they posted really strong profits, especially if you looked at adjusted ROE we talked about.
Hmm.
That's driven by solid efficiency and continued AUM growth.
Right.
But I think the real story here is how actively management is steering the ship. They're deliberately slowing down disbursements a bit, pausing expansion in newer areas, all to actively manage and contain these very specific, localized risks they've identified in the textile and leather sectors.
Yeah, the key takeaway has to be the granularity of the risk management. It's impressive. They're not just looking at overall numbers, they're successfully identifying these concentrated pockets of risk tied to bigger things like tariffs, and then using that very precise knowledge to justify tapping the brakes on growth temporarily. They're definitely choosing quality over just quantity right now. And that leads to a final, maybe provocative thought for you to chew on. Management themselves highlighted that when they enter new, less mature markets, it naturally dilutes their overall market share growth rate a bit in the short term. So, this current strategy pausing expansion in places like UP and Uttarakhand to double down on their established states. How will that play out? It's this classic trade off, isn't it? You sacrifice potentially faster new market penetration for maybe higher density and lower risk in your core areas. How will that choice impact both their immediate risk numbers and that longer term ambition of growing market share all across India? It really highlights that balancing act between expansion and prudence.